We just wrapped up a great episode with Josh Shein. Josh Shein is a private money lender working out of Maryland, and he covers about a 2-hour radius. And he sat down with us for about an hour, talked about all things private money, financing, leverage, and all the smart ways to go about it. And he also talked to us a little bit about all the things that you should avoid doing when you're getting into a private money situation. So all in all, very, very useful conversation that we had with Josh, and you're not going to want to miss it.
Make sure you listen till the end because we talk about the state of the market, kind of his little predictions on what's going on with everything, as well as wrap a nice little bow around all things private money. So listen to the end and I'm sure you'll love it. How's it going, everybody? And welcome back to the Real FI podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion. How's it going today, James?
It's going well today, Patrick, and I'm very excited about today's episode. We have Josh Shein on with us, and we're going to be talking all things real estate and lending. So without further ado, let's go ahead and get into it. Josh, why don't you introduce yourself and tell our listeners a little bit about what you got going on?
Sounds great. Thanks for having me, guys. Really love being on. Love what you guys do. Love everything you share and all the information you have out there. So it's great stuff. Glad to be here chatting with you guys. Trius Lending, we're a regional private money lender. We've got about just shy of $70 million in loans out in the sort of greater Baltimore region. Those are sort of short-term 1-year loans to real estate investors. And we provide those funds to people doing fix and flips, fix and holds, just quick close. We've done commercial properties of, 2, 3, 4 million, and row homes in the city for, 100,000, which is our minimum loan amount. We've done rehab only, purchase and rehab, any combination thereof. And then we've got a division that does the exit loans too, to get out of the short-term loan and into a 30-year fixed. So we do all of those loans as well. And again, we focus on the Mid-Atlantic. We've been doing this since 2003. We raise funds from private investors, friends and family, sort of in the local marketplace. Every dollar of that is our own money and friends and family. And it's just been going really well. And we just love building relationships. We love sort of long-term, valuable relationships with all of our clients to help them grow, regardless of where they're starting from, just sort of evolution, sort of cradle to grave. Hopefully the grave is, 100 years down the road with 100 properties, but we like to be able to handle it all with all of our clients and provide just outstanding service at every step.
So when it comes to your exit loans, are you holding those within Trius as well, your lending company, or are you selling those onto the secondary market?
Yeah, so we're selling those. So we're brokering and selling those depending on the type of loan involved there. So our core, the loans that we're holding, servicing, keeping are all the short-term private money loans, right? So that's our core business. That's sort of the business has been around since 2003. As the market evolved and as the flips became a little less fashionable, a little less profitable, obviously, as well as the market has shifted over the last few years, we said, hey, let's sort of be aware of what this shift is, and let's open up this opportunity as part of our business plan to sort of add this additional channel to be able to offer this to our clients who are saying, hey, I'm paying off, I'm calling the bank, or I'm calling this or that mortgage company. We were like, we can do that too. I've been in the mortgage business for 22 years. So most of that time was in traditional mortgages, traditional refis and purchases on the owner-occupied, homeowner side. So I have a lot of experience with sort of, packaging up the loans, brokering them, selling them, delivering them, whatever it might be. So it was real natural for us to add that option. And I think it's really worked well to be able to, we have clients' documents, we have knowledge of the property, we have knowledge of what was rehabbed and done. That helps us tell that story and helps us deliver, I think, a cleaner product in a shorter amount of time than having to go to another third party after the fact.
Gotcha. And, you're mentioning like your history in the lending space. I'm very curious. Tell our listeners a little bit how you got into private money lending and what your background is and like what led you to be doing what you're doing today.
Sure. Originally from Providence, Rhode Island. I'm a New England guy and worked with a family business. We had a medical products company. Long story short, we got acquired by a company based here, a medical company based here. So my parents and my wife and I moved down here in '99 and very quickly got out of that business and got into mortgages. And so I got into traditional mortgages with a partner at the time. And we had a company, Great Oak Lending Partners. Wrote it out through the early 2000s into 2008. We had branches and multiple offices, the whole bit. And then we sort of sat there and watched as the entire economy and mortgage and banking melted down. It was an incredible experience to be on the front lines of that. watching companies go out of business. We had calls from our warehouse lines, which are the loans and the lines of credit that banks give you. We had those calls coming to us saying, the 5 million you were going to close today, you don't have the warehouse facility to do that. We're shutting the lines of credit off. And these were, subsidiaries of Lehman Brothers and Bear Stearns and IndyMac and all the big names you heard out there countrywide. And it was pretty crazy to have those shut down immediately. It wasn't like we're going to shut down at the end of the month or we're going to shut down at the end of the week. It was right this minute, as I'm hanging up this phone, your lines of credit are shut down because the whole economy is imploding. Crazy times. Long story short, rode through that, survived through that, got really heavily into reverse mortgages, which is an FHA product also for homeowners to stay in their home when they're above the age of 62. So did that, worked at a larger mortgage company on a national level, was traveling around the country, coast to coast, north, south, east, west, Michigan, California, Georgia, et cetera. And got a little fried from living on the road, and also fried from that corporate world. I don't wish that on my worst enemy. Too many reports, too many conference calls, too many meetings. Wanted to go back to my own thing. I had my own company for all those years. So I reconnected with Steve Bond, who had been, we'd worked together in the mortgage industry beforehand when I had my company, and he had always done hard money lending. It was a second career for him, and he was doing really well with it. And I said, I'm done traveling. I'm done with the corporate nonsense. And quite frankly, I'm done with the owner occupied sort of one-time deal. You buy a home, maybe you refinance down the road, but it's not that long-term ongoing relationship. And that's really what I wanted. I wanted a more local and a more relationship-based approach. That's really where I feel that my strength in a relationship kind of person lies. And I really wanted to cultivate that. And so I said, let's do this. And so his son, David, came on. I came on. The three of us came on to the existing entity, which had already been doing incredibly well. And we've pretty much, at this point, probably 6x'd it in the last 5 years. So we've done an incredible job. We were on the Inc. 500 fastest growing list. We're on the BBJ fastest growing list. We were #1 in the Baltimore Business Journal for fast growing company. So we've really done incredibly well in just continuing our model of incredible service, incredible attention to detail, and really cultivating the relationships with clients, really caring, we think, more than anyone else out there. And really meaning it, saying what we do, doing what we say. It sounds basic. It sounds like the stuff everyone should be doing, but the reality is not everyone does it. So that's what got me back into, or got me into this side of the real estate lending industry and real estate investing. And I love it because we can work with a client 1 week, and maybe he or she is buying another property in 2 weeks, and maybe in 6 months, he or she is buying a multifamily and a strip center a year later, and a commercial 2 years later, and a portfolio of 30 loans later. And we want to be a part of that whole life cycle. And it's really working well for us. And we've just got an incredible database of clients, and we work really closely with them every day.
Yeah, that's that's really amazing. And I know that I personally have been to quite a few meetups where, you guys have been there and talked about private money. And I think for a lot of the listeners out there, it's piquing their interest because they've heard about this private money, but you've also heard horror stories of people online getting, not so good experiences. So I like how you talked about that, because surprisingly enough, a lot of people just don't meet the simple expectations that you're talking about on even being able to close the loan, being responsive, answering questions, not having the term sheet change down the road. Like these little tiny things that make a really big difference, I think, turn people off to the private money and the hard money section. And if they could, someone like myself, who you kind of just described, buying the property, then 6 months later, then the commercial, then the apartment building, and getting into all the other stuff. That's my journey, but I've kind of done it more in the commercial standard area, with the regional banks, and getting putting the 25% downs and financing all of the renovation and everything on my own dime for those cash out refinances. So there's like those two different plays, and that's kind of what I'm really looking forward to get into, is talking about how you help investors like myself being able to, hopefully you can tell us a little bit about the standard down payments, the terms, if you guys finance renovations, and kind of how that all works to, like you said, then package you up and present you to a regional bank but
Yep.
you've got all of the details behind that. So that's kind of what it sounds like we're getting into. And let's start touching base on some of that.
I love everything you said and agree 100%. Not a week goes by where we don't hear from someone who had worked with either another private lender or was sort of too early for sort of the traditional bank financing. They weren't ready. They're in this sort of state of limbo, not big enough, not experienced enough financially, whatever it might be. And they're getting burned. They're taking too long. Terms are changing. I literally heard today about someone who was originally 20% down, just got changed to 40% down day of closing. They're coming to us to see if we can turn it around. Now I can turn that around. If title work is done, I can close in one day. Okay. I don't like to do it. It's not fun. We got to drop everything and go crazy, but we can do it and we do it. And that's when we run into those situations when terms have changed. And it's famously, it happens with some of the national larger players who don't have the regional and local knowledge that we have. So we deal with everything in about 2-hour radius from our office here in Towson, Maryland. And so, Philly, York, Harrisburg, Delaware, all of Maryland, DC, we actually go even to South Virginia, so all of Virginia. And so we know the area, we know the market, we know the players, we know what's going on. When you have someone in New York or Colorado or Texas or California trying to close that loan here, they may not know what's going on. And so what happens is inevitably at the last minute, maybe it's in Baltimore City, it's a ground rent issue. Maybe it's just a value issue because they're not comfortable with the area and they got a second, third, or fourth appraisal or valuation opinion, and that's what's messing things up. And they won't hesitate at the last minute to say, terms are off, deal's done. That's just not how we conduct business, and that's not how we believe it should be done. So we never change terms. We never have to modify from that. And the other part you mentioned is just that evolution of growth, right? So many people get afraid of leverage, afraid of borrowing, afraid of using other people's money. I would argue OPM is the way to go, right? That's how you grow your business. We see time and again the most successful people using borrowed money to grow their business. A quick analogy, a quick example on that. Apple is the most profitable company in the world. Their valuation, I was looking at it with my son the other day, it's coming close to $3 trillion is their market cap. Okay. The amount of cash they have is unheard of. Through that sort of life cycle, through their evolution, they've borrowed money. There's situations where they'll have 50 billion in the bank. They'll still borrow money. Why? Leverage. Borrowing money is still a smart, valuable, and important way to grow your business, having access to additional capital, even if you have the cash. And so we deal with clients over and over again that sometimes might have the money. Sure, we deal with a ton of people that don't, and that's the main reason to borrow money. But a lot of people say, I have the cash, or we work with people who get to a point. I have someone who has 200 rental properties. He has a lot of cash. He makes a lot of money. He still comes to us. Why? It's easy. It's quick. It streamlines it. He wants his cash in reserves. He wants his cash for rainy day. He wants his cash in the equities putting into this or that property or wherever else he's diversifying his assets. And so he understands the benefit of leverage to stretch that dollar. And that's how the business works to grow properly. You simply cannot scale without borrowing the money. So with our clients that we work with, and if it's okay, I'll jump right into some of the sort of basic terms that we offer our clients. So clients will come to us and say, all right, I'm going to buy a place for 200,000 and I'm going to put 100 in rehab into it. So they're going to need $300,000 plus closing costs. Ballpark those closing costs at $25,000 or $30,000. Figure that's 330 out of pocket. We'll run into situations where the clients will call and say, I actually have the 350,000 in savings, but that's all I have. Or maybe I have 500 and that's a huge chunk of it. Now, if you have any amount of that money, some of it, all of it, or more than it, you've done a great job saving, and that's incredible and that's impressive and well done. Do you want to put all of that in one basket? Do you want to put all that to work and not have resources, not have backup, not have reserves for the rainy day or for another deal or opportunity? And so the way we think leverage works best is by putting a smaller amount down and stretching that dollar. So we'll ask that client to put down 20% of the purchase price. So in that scenario, it's a $200,000 purchase. So 20% of that is going to be $40,000. We'll fund the other 80% of the purchase price, and we'll fund 100% of the rehab. Okay. So that client is bringing 40,000 in equity, and that's not a fee. That's going towards your ownership in that property, and then the closing costs. Okay. So maybe again, $65,000 is the total you need. But where that $65,000 you're putting out there, you're getting access to 100,000 in rehab and 160,000 in the purchase. So you're actually borrowing $260,000 for $60,000+. That's like the epitome or the definition of leverage, right? You're putting a small amount of money, it's giving you access to a tremendous amount of money. And so all the extra cash you had, assuming you had that 350 whatever $1,000, that's all sitting in reserves. You can use it to do a second deal. You can use it for a rainy day. You can use it for maybe something goes wrong. Maybe your rehab increases and you need more money than we sort of authorized on the front end, whatever it might be. Or maybe, just maybe, you're going to sleep that much better at night knowing I've only had to put this much exposed money out there than this much, right? I mean, I don't want to use the analogy gambling, but to some extent what we're doing is educated and informed gambling, but any type of investment has some element of risk to it. So there's some element of gambling to it. You don't put all of your chips in on one hand necessarily, unless it's a guaranteed done deal, right? So that's how leverage and balance works. So that client then has the opportunity when someone comes down the road, the neighbor comes and says, I love what you're doing. Can you buy my property? And we get these calls from clients who say, I used my cash and now the neighbor's coming to me and wants me to buy their property. I used all my cash and now I want to buy a new property 3 blocks away and I haven't sold the property yet. Every once in a while, those stories come up and they're calling us because I'll do the refi too, right? So if someone paid all cash, did the rehab in all cash, now they own, we did one 10 days ago, $400,000 property. We gave that client $300,000. Took him 3 days, okay? Gave us his information. We approved, closed, and dispersed the funds. He now has $300,000 to go and do with it what he wants. And that's a beautiful option as well. Now, should he have come to us in the first place? I would argue, I think that would have been a better move in the first place. He didn't know he was going to need the money. So our best clients, our most seasoned clients, really our most experienced clients are always borrowing. So they always have the cash and always have the reserves for the you never know moment, right? They just want the backup to have that there. Now, as our relationship with our clients strengthen, those terms can get a little better. So we'll do, less money down. We sharpen our pencil on rates and points as well. Generally speaking, out of the gate, we're 13% interest. It's an interest-only loan, 1 year. Most of them are done in about 8 or 9 months. And generally 3 points. A point is a percent of the loan amount. That's a fee that we charge. Those are the standard starting rates that are out there. And everyone says, what do I get for that? You get a service, you get attention. We're going to meet you at the property. We're going to walk through the property with you. We're going to give you advice and feedback on what kind of rehab you should do and advice and feedback as to whether that rehab makes sense or not. One of our strengths that really sets us apart, we think, is telling clients the brutal, honest truth. Maybe when not to do the deal, maybe when they're paying too much, maybe when their rehab is either way too low or way too high. We're just straight up and honest. Yes, we want to close loans. Yes, we're a for-profit business. But at the same time, we feel that the honest and upfront truth right out of the gate is going to serve us well for the best long-term relationship. Having spent nearly 20 years in the regular mortgage business, that's not how your brain is trained to think, right? In the regular mortgage business, it's close the transaction, package it up, and sell it. I don't really necessarily care what happens later on, as long as it fits within a matrix, within a box of X credit score, X debt to income ratio, X loan to value. That's all that matters, and you sell the loan off. Because we're servicing these loans and keeping these loans here in our office in Towson, we receive every payment. We send our investors their payments. We track taxes, insurance, everything. Because of that, we really, truly care, and it's in our best interest to care about the long-term strength of the client, long-term strength and profitability of that deal. And that's, I think, very unique. Your average big national player, larger regional player, what do they care? They close the loan, they make their fees, they move on. Maybe you come back to them, maybe you don't. Do they really, truly want to build that long-term relationship? I don't know. They will say they will, but I would argue the proof's in the pudding. And so we really do, and that's really what sets us apart. And it's served us so well. We've told clients, I'll look at the deal. I can make money in this deal. I'm safe on this deal. But I don't think you as a client should do this deal. You're way overpaying. We had a situation just 3 weeks ago. We said, go back and see if you can negotiate. These are interesting times we're in now. Sellers and buyers haven't really come to the proper meeting point on agreeing on those prices, right? Sellers are still holding out for the higher number. The buyers are looking for that floor, right? And there's a lot of struggle, a lot of back and forth going on. And in this situation, we just didn't feel that the money made sense. And we said to the buyer, go back to that seller, push them. But use hard money and leverage and speed, which is really our key, as your opportunity for leverage. He went back, he said, can we get $25,000 off? He didn't get 25,000, he got 20. That's still a win. That's real money. That made a big difference. That's affecting his ROI in a very meaningful way. And he used the opportunity to say, give me $25,000 off. I can close in 5 business days. That's the benefit of us versus a bank, right? You go to a bank, it's going to take a lot longer. You go to a larger national lender, it's going to take a lot longer. I can close within days, assuming the title work is done. I can close immediately. And that allows you to sort of win that bid, win that seller's trust, and just win the deal overall because you can move quicker and better than most anyone out there. And that's a real plus.
I really like that because I think, what you're doing is you're building loyalty with your customers, and what you're doing is you're prioritizing the relationship over the transaction. I've worked with plenty of lenders and other real estate agents and brokers who, at the end of the day, ultimately are just motivated by the commission check or the closing points or whatever, and they're not seeing long term. And what I really like about what you guys have done with your business is you're understanding that if you can tell your clients the hard no and educate them, that's going to make them a lifetime client. And I mean, who wouldn't prefer to have 10 clients to do 10 deals than 100 clients that do one deal?
That's exactly
You're
it.
going to streamline your business that way, and you're going to build very loyal clients. So I think that's awesome. Tell us a little bit about your philosophy on geography, because I know that you guys only lend within that tight radius. Talk about that a little bit.
So early on, we realized, and let me just sort of sidestep for a second on the brokered loans, on those long-term exit loans, we do that on a national level, right? Because I'm not holding and servicing those. So we just did a deal in Texas the other day. We have a deal in Ohio going right now. So we'll do those anywhere, wherever there's opportunity, wherever we think we can offer great service and follow up for our clients. But because we're not keeping those loans, we don't really have to pay as much attention to that geography. The main mode, sort of reason behind us staying local is an eyes-on, hands-on approach. If we look at our portfolio of just shy of 70 million in loans that we have out there, we have visited, I would say, 99% of the properties in person. We have met 99% of the clients in person, eyes-on, right? That is very unique. We feel that that is one of the differentiating factors for our successful track record, for a very strong portfolio with an incredibly low level of defaults. I mean, like fractions of defaults. I talked to other hard money lenders, foreclosures here, foreclosures there. Knock on wood, we have very, very few. And we think that's because we meet every client, because we visit every property. I don't have to trust a third-party appraiser. I don't have to trust what I may or may not see on Zillow or Redfin or Google Street View, right? I want to see it. We want to see it for ourselves. We don't send a third party out. It's a member of our team. It's one of our internal people that will physically drive. Maybe it's to Richmond, Virginia. Maybe it's to downtown Baltimore. Maybe it's to Philly. And they will go and they will look. And there's nothing like looking, touching, and feeling the property. We think in real estate, that is what matters. And if it's a big enough deal and you have to fly to it, and I would give this advice to anyone anywhere, if you're based in DC and you're buying a place in Ohio, if it's $50,000, may or may not be worth it. I would say it's still worth it. But certainly if you're spending a few $100,000, jump on a Southwest flight, head out to Cleveland, check it out. You want to see the neighborhood. You want to see the street. You want to see the building. You want to feel the basement. Smell. Is there mold, right? There's certain things you pick up when you're in person, and you just can't replicate that, I don't think, any other way. This is sort of the anti-technology approach, right? Everyone's just like FaceTiming and using maybe an AI model or an AVM to sort of figure out the values. Nothing wrong with that, but I would say nothing truly replaces that hands-on approach. And the same thing goes for meeting our borrowers. We meet in person. We get a feel for each other. What are you trying to accomplish? What are you trying to do? If you have time to read our Google reviews, you'll see people that say, these guys really are different. They're really not just looking to do a transaction. They're really looking out for your success. They gave me advice on finishing this basement. I was ready to do it. And they said, not worth the money. Why are you spending the money? And we explained to them what our argument was. So we're saving clients money and, again, looking at the long-term benefit. I don't want to do 1 or 2 or 3 deals with you. I want to do 50 deals with you. And I want to do them for the rest of your time in the real estate business and the rest of my time in the real estate business, which is going to be, when I'm carried out of here and who knows how many years, right? I love what I do. And we want to work with clients who love what they do, in it for the long term, and we want to be there every step of the way. If that trust is built up, and I'll give you another example. We have a client who's been with us for many, many years. Even if he's not using us for the financing and he has enough cash, that sometimes he still does use his own. I mean, it does still happen, right? It makes sense. Or bank financing too, right? He's got a line of credit with a bank. They're great rates. It's easy stuff. No problem, right? He'll still come to us and say, hey, I'm buying this portfolio of 3 or 4 places. Take a look at this. See what you guys think. And we'll just get on the phone and we'll sort of talk through it. There's still a trust that we've built up over the years that he wants our feedback and our opinion and our 2 cents, because we're not doing it for the sole purpose of just trying to close a deal. We're doing it because we want to help them out and want to build a long-term relationship. And he's like, I trust their opinion. I trust their opinion as if they're business partners. And that's how we've sort of approached our businesses. We want to be acting as a partner without actually taking that piece of equity away from you, right? And so that we just think it's a smart approach and the best long-term approach, and it's serving us well over and over again. And so we just think, in that vein, to come full circle, I can't go past that sort of driving distance and still provide that level of service. And we think that's just fine. We can stay in our area, we can kick butt, we can do a great job for all of our clients, and we can make everyone a heck of a lot of money, and that's great. Still a win-win.
Well, that sounds great, and I I really appreciate that way that you guys are running your business. So let's just say, for someone that's in that circle, right? So someone that's listening, someone's in that circle, they're calling you up. What are your guys' like minimum kind of requirements for a property? You know, I know a lot of people are looking for that 1 to 4 unit small multifamily property. So let's break down credit
Sure.
scores, you know,
Sure.
you're looking for experience that you're looking for, just to kind of get the ball rolling so they can take that first step in building that long-term relationship.
Absolutely. No, great question. You know, the misconception in private lending, hard money lending, is, you know, equity lenders, right? Just looking at the property, not caring about anything else. For us, that is not the case. We actually, as I mentioned, we visit the property, visit the person, but we also want to dig into that client and understand what's going on. We do it very quickly, but we do want to see certain aspects. So generally, our minimum loan amount is 100,000. Okay, so I'll just start there as sort of our basic. Generally, 1.5 million. We'll go above that, but generally 100,000, 1.5 million is our sweet spot. Any type of property in that range, as long as it's a non-owner occupied property, an investment property. It can be traditional commercial, office, retail, strip center, mixed use, or a row home in Baltimore City. Okay, we're going to ask for a few basic pieces of information, and we're going to make very common sense decisions based on that. Number one, we're going to look at your credit. Don't care about your score. Doesn't matter. Throw your score out the window. How does your credit actually look? I've been in the business 22 years, 23 years. I've seen literally probably hundreds of thousands of credit reports if I think about it. Okay. So I want to see, do you have credit lines, trade lines? Do you have a mortgage, or have you had a mortgage and or a car and or a credit card? Don't care about T-Mobile bill. Don't care about a patient first bill. And I don't care about defaults on an education loan or T-Mobile or a patient first. Okay. I care about the big three things: car, mortgage, and credit cards, right? How have you been extended credit? And how have you paid those bills? Have they been on time or not? If they're not on time, still open-minded. My famous story is a guy who made a ton of money, had a really nasty divorce. Leading up to the divorce, he and his wife decided to stop paying all the bills altogether. Screw you, whatever. I don't want to get into that detail, but it got messy, right? I could see, looking at his credit report, before he had those lates, he was always on time. After the divorce, he was always on time. It was during that time in between, it was about a 9-month period, all red, all lates on his credit report. Okay, I get it. It made sense. His score was awful. I don't care about the score. I care about how you look and how you pay your bills. So number one, do you pay your bills on time? Period. End of story, regardless of score. Yes, you do. Okay, let's move on to number two. Number two, income. Can you show me in some documentable, verifiable way how you pay your monthly obligations on your credit report, the car loan, the mortgage, and the credit card bills we talked about, and the new mortgage I'm going to extend to you? So if I'm going to give you a mortgage, you're going to pay me $2,500 a month. Where's that $2,500 coming from? The famous line is, I got it. Don't worry. Well, it doesn't work like that. Okay. I need to verify something, right? A barber, it's tough, right? You're not showing that income, and you're probably putting it in your pocket, and I don't blame you. I'm not the IRS, right? If you can put it in your pocket and not declare it, go for it, right? So cash businesses, sometimes we'll say, hey, I'm going to need you to pay 6 or 8 months in advance because I can't see the consistent income. But self-employed, show me bank statements. 1099, show me the history. W-2, obviously those are easy. Business tax returns, whatever it might be. I've had people send me Cash App, Venmo screenshot, as long as I can see the consistency, that there's a pattern of it. I have a guy, he has a vending route, and there's Venmos, there's Cash Apps, there's all sorts of stuff, but he's actually declaring a lot of it, which, I mean, he's probably not declaring a ton. He's not showing me, but the part he is showing me is documentable and verifiable to get him approved. So I looked at all the screenshots and could see that for months and months and months and months and months, he consistently brings in enough to make those payments. That's step two. Show me that you can afford my payment. Very common sense. And I'll say it just like that to the client, he, she, whatever. How are you going to make the payments? Just show me that I know that you're going to make it every single month, and I can see that there's a dependable, reliable stream of income. That's number two. Number three, assets, right? Do you have enough money for the down payment and closing costs? Generally 20% down of the purchase price plus closing costs. The more you have, the better, right? If I need 60,000 from you and you show me a bank statement that's got 62,000, you're good for the deal. But I'm going to say to you on the phone, because again, I'm looking out for a long-term relationship, and I've done this more times than I can count. I'll say, you know, you've got the money, but when you close this loan, you've got no reserves. What if there's mold in the basement, you didn't realize it? What if there's a leak that ends up happening? What if your basement floods? What if there's termites you weren't aware of? You're not going to have any reserves. I don't want you tapping into credit cards at 24% if you run into some issues. And inevitably they'll go, oh, no, I've got a retirement account with 300,000. My wife's got a savings account with 200,000. I just didn't think you needed to see that. Fair enough. I didn't need to see that, but I want to see that because it makes you look like a better borrower. So what I tell people now is the more you can show me, the better. I don't care if we can't access it. I don't care if it's locked away like a 401k or an IRA. It doesn't matter. The more you show me, the better. I can feel better about what risks you're taking and making sure you're making smart moves with your money, because I want to help give you that advice along the way. So you're safe, you're conservative, you're in a good position, not taking on too much risk. I had a guy who came to me who was using his last dollar and last penny for this deal and barely had enough money to make the payments. I said, honestly, I can't do this deal. And I would have made good money on it. I can't do this deal. You are way overextending yourself. It was a pretty large purchase. It was his first time doing it. It was a 20-year-old guy. He had some decent money saved up. It was a bad move. He did listen to me. He did bail on that. And he did go and get a smaller purchase first time out. And we've done many deals since then. And I think he appreciated it. He may or may not have been okay on that first one, but there's no reason to be up at night, not sleeping. Okay. That's the key.
Exactly.
I want to look out for that and be like, hey, man, you might have some stressful nights. You're not going to sleep like a baby every night, okay? But at the same time, like overall, you should be able to say, hey, I'm good. I got this under control. I trust my lender. I trust my contractor, hopefully. I trust who's doing the work. I trust my suppliers. I know what I'm doing. I'm taking this one step at a time. We can walk before we run, and then we can run really quickly, and then we can sprint like crazy. But let's get there one step at a time. And that's really important for us. So those three aspects, credit history, payment history, income to be able to make the payment, and down payment. That approves you as a borrower. So then you're good. At that point, do you have a property? And if you have a property, I'm going to do two things. One is the online in-office research, and then the in-person, as I mentioned. So the online in-office research is going to be Zillow, Redfin, some proprietary systems we use, Google Street View, looking at comps, looking at the area. We've done thousands and thousands of loans. We have sometimes we'll run into a situation and say, oh, we did the loan 2 blocks away. We did the loan a mile away. Let's look at that area. How did we do there? We have a lot of intel and data we can look at. So assuming everything looks good online and in a sort of technology screen perspective, then we say, okay, let's get out there and meet you. All of this happens within a few hours. So if someone submits the information to me right now, I'm generally going to have word to them by the end of today or at the latest tomorrow, and we'll schedule a visit as quickly as they need us to. So if you're looking to close in a few days and the title work's moving along, I'll get there quickly. If you say I've got 2 weeks, then I'll say let's get there in 3 or 4 business days. But I want to move things along. It's all about speed and efficiency. It's all about speed and efficiency to get that property acquired, get in there to rehab it, and get out of it to either rent it and refinance it if you're doing a BRRRR strategy, or just to flip it, right? Just to get that on the market and sell it. So I want to work as quickly as you need me to work. And we can pivot and adjust speed, efficiency, however the client needs for that to happen. So it's a very streamlined process and a very common sense process. I don't need 50 years of tax returns. I don't need details on bank statements to source this deposit and tell me what this is from and who gave you that money. I don't really care. You either have the money for the down payment or you don't, right? I mean, that's it, right? So very common sense. And we think that serves us and our clients well. Again, at the end of the day, can you afford it? How do you pay your bills? Do you have the money to bring to the table? That's it.
I like that. It's pretty simple.
One thing I do want to ask though, okay, just for everybody out there, let's say, okay, so we got the loan. One thing that I think people, sometimes need to understand is how that 13% interest is paid out. Okay, let's for simple terms, we've got $100,000 loan, and that was for the property and the renovation cost. To make it real simple, so that 13%. Is that how is that paid off on that 100,000?
The easiest math in the world: $100,000 loan, 13%. 13,000 is the annual amount. Divide that by 12. That's your monthly payment. End of story. You only pay for the time you have the loan. This is a big question I get. Everyone's like, well, do I have to pay for the full year? If you pay, I don't have a prepay penalty. I require 3 months of being in the loan, but there's no penalty or anything like that. So after 4 months, if you're done with the work somehow, which I've had very few, but sometimes it happens, right? You're really quick, you're really efficient, and somehow none of the supply chain issues we've had over the last few years has impacted you, and you're out in 4 months, you pay me off and you only make the 4 payments you made. You never double pay interest, you never overpay interest. From the day you close until the day you pay off the loan, you pay interest for every day you have the loan, but never more than that. Generally, as I mentioned earlier, 8 to 9 months, most of our loans are paid off. So yes, it's 13,000 divided by 12, which is whatever, 1,100 or whatever per month, right? But you're only going to pay that for the months you have it. And once you're paid off and you're done. And what I want to do is I want to turn it around, get you another loan. We want to rinse and repeat. That's how we all grow our businesses. That's how we help you grow your portfolio, grow your number of flips, increase your profit, increase your bottom line. That's how we all succeed. So that is a really big question we get. And the second side of that is over time, what happens? So some people go more than a year. I have someone right now, they're on their 3rd contractor. Total nightmare, right? It just happens, right? Sometimes Murphy's Law kicks in, right? Contractor after contractor after contractor, inspector issues, supply chain issues. They're over a year, that they might even get to 2 years at this point. So we do allow for an extension after 1 year. So they have to pay a fee to extend it, and we extend for another year after that. No one wants to do that. I don't want them in a loan more than 8 or 9 months. They don't want to be in a loan more than 8 or 9 months. But sometimes stuff happens. It's nice to have that flexibility to know that you're covered in case that does come up as an issue. The other
Completely
important
understand.
thing to keep in mind is rehab funds. This is where people really can get burned. That 100,000 we've talked about in that example, 100,000 for your rehab, I don't just write you a check, right? I'm looking out for you, for me, for us collectively, because we're in this together, right? I've got a lot of money in the line. You as a client have a lot of money in the line. The contractor, we need to make sure they're doing their job too. So we disperse funds generally same day, okay? Only when work is complete, never before. We've had too many stories, more than I can count, I promise you. Contractors getting the deposit, disappearing out of town, okay? And you might say, that's crazy. When I did work on my house, that didn't happen. Home renovations and the home general contractor business is a little different. Large commercial, a little different. I've had guys say, hey, I did a $600,000 renovation on this large building. I had to put a third down or a quarter down with a national contractor or a $25 million regional contractor. Totally makes sense. I totally get it. When you're talking about 3 guys who are doing a renovation on a $250,000 rental property or potential flip, they're just 3 guys. And there's nothing wrong with 3 guys. Don't get me wrong. I love small business. I love small general contractors. It's great stuff. But you never know what you're getting into, and you got to protect yourself. And we want to make sure our clients and that we are protected. So by making sure they're only paid out and dispersed as work is done, no one can possibly get burned. Now, it means more work for me. I have to disperse those rehab funds on an ongoing basis. It's not going to be 3 or 4. It might be 10 or 12. You might gut this place and you might frame it out, and I might give you $7 grand. And then 3 days later, you might say, hey, they did a little more. It's payday. They need some more money. No problem. I might be doing every Friday. I have no problem doing that. Better to be safe than sorry. I'll give you smaller amounts more frequently to know that you're covered and I'm covered and we can't get burned. That's the key. And that's really important. And that's where a lot of people can get killed in this business. The rehab, over budget, screwed by a contractor, someone runs away, not paying attention to the work being done. The rehab side of things is really where a lot of people get hurt.
And I think the milestones and the periodic disbursements are key to kind of any project that you're going to take on, even home renovations. Like that's just a prudent thing to do. But when it comes to the contractors that are working with a lot of your clients, are you vetting those contractors specifically? Are you letting your clients kind of choose whoever they want to work with? Are you requiring contractor licenses, or are you kind of just trusting them that we're going to do these periodic disbursements and we're going to know pretty quickly if these things aren't being done properly?
Great question. We get this one a lot. Where we've come to is because of the method of our disbursements, and we feel it's the safest way to everyone to be protected. I feel like we don't have to do as much research on the front end. Okay, so we're covered either way. So I don't require permits. and inspections and licenses, I certainly heavily, strongly encourage every single person to do that the right way. I have people say, hey, I'm going to do it on my own. I'm going to do it with my dad on weekends. What am I going to do? Right. I mean, so there are those situations that come up, or my uncle's a contractor, like, okay, fine. Right. But I give them the risks. I review with them how we're still going to do it no matter what. It's still going to be safe because of how we're going to disperse those funds. So if I know the contractor, I'll give them a thumbs up. If I know the contractor was bad and we have a lot that we know are not good, I'll tell them I would not work with that guy and I will not support you working with that guy. I won't fund the loan if that's who you're working with. So we'll do that too. We don't publish those lists at all, but we sort of will talk with people about that. But other than that, they are pretty much on their own. And that's the biggest question we get is, how do I find a good contractor? How do I stick with a good contractor? That is the $1,000,000 question, right? Finding a good property, finding a good contractor. If you can solve those, you solve the world's riddles, right? You'll be guaranteed success. I mean, it's so hard. And if you do find someone, keep them close, keep them happy, and keep them busy, quite frankly, right? So it's easier said than done, but people do it, people can do it, people have done it. But we do feel that because of the way we handle the disbursements, we're playing it safe for everyone in that sense.
Yeah, that makes a ton of sense, and that's usually the biggest question, and I think that part has been for me the most hesitant on why we've kind of self-funded everything because of those draw periods. Like, all right, well, do I still need the cash if the bank is going to be really slow? Because a lot of the times it's those regional banks, and hey,
Yeah.
they'll fund the renovations, but man, is there a ton of paperwork? Man,
Well,
it's more complicated to get the renovation fund than to
right.
buy the actual
Then to do
building.
the deal. Yeah. No,
Yeah.
you're 100% right. And that's where we think we set ourselves apart. And I would argue that the small sort of regional lender, if they're like us, hopefully will set things apart from a bank or a larger institution. Okay. I'm not sending a third party out to do the inspection. I'm not waiting for a report to get back. Generally speaking, I would say 85% of the time it's a video that's sent to us from our clients. We inspected the property in the front end. So I have video and records from my initial inspection of the property. So I know that I'm looking at the right property, the right rooms, the right inside, the right outside. They're sending us the video. I recommend all of our clients, give me a heads up, right? If you're going to be looking for, $16,000 on Thursday, tell me on Tuesday, hey, I got a draw request coming to you. It'll be either Wednesday night or early Thursday morning. I'd love to get it in time for payday Friday. No problem. I'm going to try to get it to you a few hours later, which is generally what we do. But it's nice to have the heads up to know what we're looking at. And we make sure they do thorough videos, inside, outside, top, bottom. Show me everything. The more I can see, the better. I don't want 3 hours of video, but instead of giving me 30 seconds, give me, maybe 5 videos of a minute or two each, so I can really get a handle on how things are coming along, see if there's issues or concerns, right? If we have any question, we're going to jump in the car and drive down there, whether it's 20 minutes away or 2 hours away. We just can't risk not paying attention to that because this is so important. But we'll disperse those funds immediately. And that's the other thing that we hear from our clients over and over again. Oh my gosh, your process for getting the money was so awesome. It was like in my account before I even called to follow up with you guys, because we know that's the key to a successful deal. The quicker I can get you and your contractor paid, quicker this deal goes. I don't want to sit on this loan. I don't want to keep earning interest on it. I want you to pay me off and come back again and again and again. That's how the real value in this business works. And so that truly is how we conduct our business on a day-to-day basis.
Exactly. And I can see, so now that we're having this conversation and we're talking and we're all learning here that's listening in, I think a lot of the times, especially in my head, it's that 13%. And you're like, man, I know what a 6% loan is going to cost me. But with that loan, you're paying principal and interest. So with this loan, you're talking about paying interest only. Now, let's say, for instance, you want to borrow $600,000 at 13%. You're now having to make these, $6,000 a month
Sure.
payments, but you're also doing it on other things. So you're getting out of it sooner, and you're going to be in kind of around this, a lot less time. So I think that's kind of what has gotten me, and I think that's kind of what gets some other people in the hesitation of of utilizing it. But now I totally understand why, and I see the benefits for sure if you're able to kind of get everything set up and front loaded, get your property, get your contractor, get everything front loaded, and like you said, you can bake in that 6 months of payments into everything.
And that's what it is. You're not in this for 30 years or 6 years or 5 years or 2 years, hopefully not even 1 year. So when you do the math, is it cheaper on a 6%, even with principal and interest? No question about it. But at the same time, if you look at the big picture and take a long-term sort of look to your business model, this is the best and easiest way to do it because it's going to be a fraction of the work on the front end to get the deal done, a fraction of the work on each time you need to draw, and a personal seasoned team that's been doing this for years on thousands of properties that is available 24 hours a day, 7 days a week, on the phone and in person for anything you need. We've had guys with insurance issues. We've driven down there within the hour of an issue to walk through it. We've had contractor disputes where we've sometimes physically stood in between the contractor and our client and been like, all right, guys, let's hold on here. You know what I mean? Let's all talk and let's figure this out, right? We've worked through so many issues. There's no charge for that. There's no fee for that. No bank is going to do that. No way. Make my payments or don't make my payments. End of story. That's not what we're doing here. So you're paying for a premium service and you're paying for that value. And when you need it, it is worth more. It's worth 25%, right? And we've had clients at that point be like, man, I don't even care at this point. This was the best thing ever. You told me what not to do. You told me what to do. There's incredible value there. And I can't be the dollar store with dollar store prices and provide that level of service. So if you want that level of service, go that route. That's fine. But if you need that support, beginners we work with all the time. It's the best thing ever because they need that help and support. But even the experienced people, like I said, they still want someone they can trust to pick up the phone. What do you think of this place? What do you think this rehab should be? This seems high. You think I should redo the landscaping outside? I feel like it's okay. I looked at the street. I'm not crazy about it. What have you guys seen on this street? That's where there's value.
And
Now,
I
will
really
you
like
guys-
that because I think a lot of people, become penny wise, pound foolish with these kind of decisions. And, they're trying to, put a dollar value on every aspect of the deal. And they're frankly over analyzing the hell out of it. And there's just all these intangibles, especially with your team in any transaction, relationship based, as we've said 100 times on the show. Real estate is a relationship based game. And the more you can go deep with those relationships with a good team around you, your attorney, your lender, private money, your long-term financing, your agent, the more you're going to get out of it. And you can't just necessarily quantify that with a dollar value. So I think that's super
sure
for people to really understand, especially when you're getting started. Sometimes it's worthwhile to pay that extra money, extra fee for that extra service, because that extra service is going to save your hide, when these speed bumps pop up down the road.
No doubt. Couldn't have said it better myself.
Now, question. Do you or would you guys just fund the renovation? Let's say someone bought a property in cash and they just want the renovations to be funded instead of using like a HELOC or their own cash, and then you package that up and send that out to a broker.
I've had every mixed combination you can think of, right? I mean, obviously the most basic ones is purchase only. They used me for self-funded the rehab. Purchase with cash, use me for the rehab, use me for both, or use cash for both and then come back to me to cash out because they need the money back because they haven't sold the property and they need to go and buy a new place or pay back some bills or what have you. So any which way, the key for us is I always need to be in first lien position, right? As long as we're in first lien position, I'll do anything. I've had people refinance other hard money loans and come to us too, which is also crazy. So like they're a year into the loan. Some depending on who you work with, some lenders are a little more forceful in getting paid off. They're calling the note, I need you paid off. There's no fee to extend this. There's no option to extend this. You have to pay us off by the end of this month. They just need to put the money back to work. They don't have enough money. We've never had that problem, thank God. But you just never know what you run into. So they call us up saying, "Listen, I got to refi my hard money loan. I'm halfway done with the work, but I need you guys to take it over." And so we'll pay off that loan, give them some additional money if they need, and put them into a brand new loan. So whatever way it works, as long as we can stay in first lien position.
So would a situation like that affect the down payment amount? So if a client of yours is coming down with, they're purchasing the land, the building, whatever, or they're doing all the self-funded renovations, is that going to affect the down payment?
For sure. Absolutely. So that down payment, that 20% down payment is a purchase, right? When you're buying the place. If you already own the place or you've already done a certain amount of work, you have skin in the game. For us, it's all about skin in the game. I need to make sure you have skin in the game so you stay in the game. If I give you 100% financing, and I literally, when I had my mortgage company years ago, I did some private lending with my partner at the time. We didn't know what we were doing, right? We were giving 100% loans all over the place. And when the market soured and things soured in '08 pretty badly, literally people were like, I'm just walking away. They didn't even care. Why didn't they care? They didn't care because they didn't put a penny into it. Not a penny, right? So if you don't have skin in the game, you're not staying in the game. What does it matter? So by making sure people have money in the game, they're not going to walk from it and they'll really care about the deal. So if you had purchased it in cash, okay, and you come to me for rehab, I'll still give you 100% of rehab because you already paid for the whole place, right? And so if you're looking to come up with some of those variations, showing you have skin in the game, that makes sense. We sometimes have people come and say, I bought it 5 years ago, I've done nothing with it. Okay, show me your settlement statement. Okay, you bought it for 70,000, you've been paying taxes, ground rent, insurance, whatever for all those years. That's skin in the game. You're absolutely committed financially and you are in this. You're not walking, and that makes a difference. The exception is the inheritance. Okay, so that's an interesting one. So we've had people who grandpa, grandma, mom, dad, what have you, handed the house over. So it was a few years ago, and the person's calling us up saying, "Hey, I got this place. I want to take out, 300,000 bucks," and they just got it for free. They've done nothing. They barely it's due for taxes and insurance. It hasn't been maintained. Place is falling apart. I'm like, we'll do the deal, but we're going to structure things a little differently. We're going to need to figure out how to make sure we're safe because you actually haven't put any money in it. You own the place for sure, legitimately. You got it handed to you, and that's a beautiful thing. Don't get me wrong, but we need to make sure we're still protected with regards to in that situation. We might ask you to put some more money down out of pocket. We might cut our LTV back a little bit. So the fixes always are, more money down and or lower LTV and or payments in advance. That's how we can fix pretty much any situation. And you can't show income if you don't have, you haven't paid your bills on time or don't have. We have people who don't have credit. They literally don't have any credit at all. They've lived off cash forever. They don't have credit card bills or mortgages or car payments, and that's just fine. We work through that, and we can fix that with some of the other methods of adjusting down payment, payments in advance, et cetera.
Very nice. Very nice. All right. And so let's talk about full cycle here. So my project, I came to you guys. I bought a 4-unit property. You guys funded the deal, funded the renovations. New tenants are in. This baby's cash flowing. We're 9 months in, but I don't want to go traditional lender route. What does that look like with you guys going out there and helping me, transition?
Yeah.
How does that work? Is that typical, is that a DSCR loan? Are you going to those regional banks? Like what does that
Yes,
look like?
yes, and yes, right. So we've got all the DSCR products out there, right? Obviously, very popular on the 1 to 4 unit. There's some incredible products out there. It's mind blowing. It brings me back to my old days in the mortgage industry. Like you don't have to show income, you don't have to show a job. It's like crazy, right? So those are great. The debt service coverage ratio loans are phenomenal. We do a lot of those as well. But in addition to that, there are situations where we want to find other alternative type lenders and or banks. And so we're working with local banks, regional banks, national banks, and also regional and national commercial lenders. There are places out there, there are lenders out there that work only in $1 million plus. There's lenders out there that focus on new construction takeout loans. There's places out there that focus on small multifamily and large multifamily and strip centers. So there's all those kinds of variations out there. And what we want to be is we want to be the sort of one-stop shop for us to be able to help find you the best source, right? And that's the traditional broker, right? I was a broker before I was a lender in the mortgage industry years and years ago. And there's nothing wrong with being a broker. It's a beautiful thing. It means someone's going to be shopping around, finding options and presenting those options to you. And so I want to be able to sit there and say, hey, I've got 3 banks. Here's what they came back with. I've got 3 lenders that focus on this type of financing. Here's what they came back with. And I got a DSCR. Here's what they came back with. Now, generally speaking, you can generally base rates and fees and on commensurate with the work, right? So in other words, the more paperwork, the more background, the more due diligence, generally it's going to be more bank and a little better on the rate, but a lot more work. DSCR, well, it's a lot less paperwork. It's a lot easier. It's going to be a little higher in rate. So it depends what you can show, what you want to show. I have some clients who are like, take 2 years of tax returns, go to the bank, give them the whole stack of papers this big, and let's figure out where to get the best source. I have another client, very successful, very well to do, doesn't want to deal with the nonsense, doesn't want to deal with the bank craziness. Just literally, it's more like it's a patience issue, right? It's just like, I don't want to get called. I don't want to be asked for stuff. What's the easiest way? If I have to pay a premium in my interest rate, I'm willing to do that. And so that's a decision that I can't make. I can advise, I can guide you on that, but you ultimately have to make the final decision saying, I don't want sort of like the magnifying glass going through myself and my significant other's life, right? I just want the easy route, no problem. Or other people said, absolutely. I'm aces. I got all my paperwork lined up. And that's the key, just really briefly, paperwork. Organized paperwork is the difference between, I believe, success and failure in the long term. You can get a deal or two done without being super organized, okay? If you want to grow in the real estate business, I think people underestimate this. Organization and paperwork is key. Our best clients who get the best terms, best rates, best situations, both with us on exit loans and in the broader sort of marketplace, have all their ducks lined up. Man, they've got their property REO schedule neat. They've got income, tax returns. They've got copies of leases. They've got credit report. They've got their ID set. They've got it all. You ask for it, they say, give me 15 minutes. It's beautiful. I'll send you a zip drive or a Dropbox. You'll have everything. A lender loves that. It shows professionalism. It shows they pay attention. I had a guy once, it was a partner, two guys, they owned, must have been 60 or 70 places. They could not show me whether they were making money or not. They sent me literally 25 bank statements. There's hundreds of thousands of dollars coming and going. They didn't know, and I didn't know. Are they making a killing? Are they losing? They were constantly buying places, selling places. You couldn't figure it out. And I said, guys, if you get your financials straight, and you get a P&L and a nice clean REO schedule with leases and purchase dates and your balances and everything, you guys will kill it. But you don't even know whether you are killing it or not until you set up that information. And they were like, oh, we don't have time for it. Well, we're going to see how that works out in the long term. I'm pretty sure I know where that's going to go. They're going to fizzle, right? Because at some point you're growing too quickly. There's too much going on. That applies to any business. Real estate investing is a business, right? You are your own business and a growing business. You need to do the same thing businesses do. Investing in software, organization, a process, accounting, the whole bit. That's so important for growth and success.
100%. Yeah, I agree fully with that. I mean, and that's really what differentiates people from those that succeed and those that don't. They treat it like a business. QuickBooks can be your best friend or your biggest enemy.
Yep.
You know, it really depends how you're looking at it. If you appreciate the organization, everything that comes around with that, it's going to really set you up to make your life easier, especially around tax time, as we all know.
Oh yeah, for sure. Yep.
I want to dig into something you had, kind of mentioned about DSCR loans. Those loans are kind of a new thing that I've kind of learned about within the last 2 years or so. Tell us about how those are structured, how you qualify for a DSCR loan, and what kind of the market rate might be for a product like that today.
Sure. No, great questions. So the DSCR loan, it takes its, I guess its existence from what really did exist as what we used to call the NINA loans, no income, no asset loans, or ninja loans. There were all sorts of different terms. These are for owner occupied back in the 07, 08 days, where there were low doc loans, minimal doc loans. And so the industry, fast forward to the last few years, came up with its own method to say, look, the rental market's strong, continues to be strong. It's forecasted to continue to remain strong. Yes, rents may fluctuate a little bit, but overall, it's cheaper and more economical to rent than to buy for the average homeowner. So we think that's going to be happening for many, many years to come. And the housing shortfall is going to continue to be a challenge for some people as well. So having said that, the industry said, okay, how do we make sense of this? Well, we make sense in saying, if their credit score is good and we like the value of the property, all we care about is that there's a lease that covers the mortgage payment. DSCR, debt service coverage ratio. So does the payment the tenant is making on a monthly basis cover the PITI, principal, interest, taxes, and insurance? That's what a mortgage payment consists of every month. If that rent covers it, hopefully, ideally, it should cover more than it. So let's just use some basic numbers. Rent is $1,800. Your PITI is $1,500. You're in the clear. Rent is $1,800. Your PITI is $1,800. It's a little tight. There are some products to do that with, but not great. Rent is $1,800. PITI is $1,900. You're upside down, right? You're going to lose money every month, and you're not going to have money for reserves, for vacancies, for repairs, etc. So in that case, it wouldn't work. So the DSCR looks for a rent that covers the mortgage payment and says, if your credit's good and the property's good, that's really all we need. The other thing that gets looked at too is assets. Again, it's always nice to show more, but the requirement generally is anywhere from 6 to 12 months of reserves for those payments that you would have to make. So say the payment's going to be, in that scenario, a $1,500 a month payment. You would need 6 to 12 months, depending on different partners and different companies out there, of that payment set aside in a bank account. You don't have to keep it set aside. It's not going to be checked on over and over again, but you need it for the underwriting process to get approved. Once you show, I've got 15 grand sitting in a checking account, boom, that part's checked off, you're good. Credit report met the minimum score. Generally, the better the score, the better your terms are going to be. And then the appraisal came in clean, and we have a good LTV as well, meaning there's enough equity to pay off the existing loan if it's a hard money loan or whatever the other loan might be. So generally speaking, you're going to be in the 70 to 75 loan to value range, okay, based on that appraisal, what it comes in at. Generally speaking, you're going to be in 30-year rates with generally a 5-year prepay. Rates have gotten better in the last few weeks, right? So you can actually get a tad under 7 to into the 7s, depending on credit score. 760 credit score, 70 LTV, you're probably looking at under 7% on a 30-year fix. 680 credit score, you're looking for 75 LTV. You're gonna have a tougher time making that work for sure. No question about it. Okay, so that's sort of how that's gonna vary. Now, rewind. No one's gonna like hearing this, but I feel like I should share it as well. Rewind a year and a half ago. Those 30-year fixed rates were 4.5. Phenomenal. You were cash flowing like crazy. It was a beautiful thing. I mean, just incredible. 90 days ago, 7.75, 8.25, 8.5. Okay, they've come down a good bit recently. Where are they in the future? Anyone's guess, right? I don't have the magic ball to know 100% where it is. The consensus seems to be that we're not going to get into the 9s. That's really what most people believe, and we're certainly not going back to the 4s, and I don't think the 5s anytime soon. My personal opinion, 23 years in this business, mid to high 6s into the low 7s is sort of where things I feel like should stay, will stay, need to be. I think that's sort of the most sensible place for it. I think that's where the market wants things to end up at. But that's anyone's guess. There's too many unknowns out there. The Fed, the economy, international relations, oil, war, you name it, that can affect those kinds of numbers in the long term.
Well, I agree. It's definitely all speculation to kind of guess like where things are going to go. That being said, though, we are curious, what are you seeing in the market? Like, what are you seeing on your side of things from the lending market today? Maybe bring into that conversation a little bit of your experience from 2008 and that time period.
So I mean, seeing the market is strong right now. I mean that's the long and short of it. We've had a tremendous start to 2023. Obviously, the bumps got everyone stressed and has everyone sort of worried overall for what's going on and where things are going. But real estate investors need to be out there doing properties, need to be buying and selling, and need to be putting things in the market to rent. They got to rehab it. They got to put things to work. If you're a full-time real estate investor, you can't just stop working, right? Do you have to do a different type of analysis? Yes. You have to figure out how to make these dollars and cents work, how to make the numbers work. Yes. Is it a lot more work? No question about it. You got to dig deeper for the deals. Inventory is still tight. No question about it. But there are still deals to do that. The other thing we're running into from our perspective is as the banks are tightening up credit, and we do believe the banks will continue to tighten up credit.
All right. So we were right there. Little technical difficulties, but we were right there just talking about we've had a phenomenal start to the beginning of the year. Real estate investors need to keep buying, selling, all of that good stuff.
And as the banks are tightening up credit, and I believe the banks will continue to tighten up credit on a larger sort of scale, on a broader scale with all this bank fallout, they're going to be tight. They're going to be worried. And so they might tighten up some of the terms. Maybe LTVs get tightened more, maybe some more paperwork. Who knows what else might be involved? But that opens up the opportunity for people to come to us and say, hey, I need access to funds. We have a few clients we're dealing with now who are running into some situations with some larger commercial transactions. That's why they're calling us up. They normally wouldn't have, to be honest, come to us, but we're going to be able to bail them out of some issues they're having with some bank loans, and that's fine with us. But having said that, overall, the market continues to be pretty good, at least in this neck of the woods, right? the nice thing about the mid-Atlantic is we don't have the high highs and the low lows that, San Francisco has, or Seattle or Manhattan or anything like that, right? We stay in sort of a narrower range, and that's why we love this market. It's close enough to DC. There's always great jobs here, and it's affordable. And so because of that, I think we stay in a narrower band of highs and lows, and that allows this market to continue to be pretty robust. And so we're pretty optimistic on it continue to be strong for the foreseeable future.
Man, well, I know that me personally, I've learned a ton from our conversation. I will 100% be reaching out because I'm in a situation right now where I could definitely utilize your guys' services. So with
Love it.
that, where do our listeners that are
Yeah.
inside that band reach out to see if you guys can help them out with a deal that they have?
Yeah, absolutely. So obviously, the best way to reach us is our website, triuslending.com. We're on all the social media platforms at Trius Lending, TRIUS, Trius Lending. And easy way to reach me is Josh at triuslending.com. I'm also on all the social media platforms, LinkedIn, Facebook, Instagram. We're on TikTok too. We're doing some stuff there too, some informational videos. We're on YouTube. So any of the social media platforms is a great way to reach out. Happy to help. And I say this to everyone all the time. Even if there's not a deal, even if you're not looking for financing, happy to share information, happy to help provide resources, knowledge. That's what we're here for, right? There's always another deal. There's always another day. It's helping each other out, helping each other grow, helping each other find success. And we've done a lot of that over the years with a lot of people. It's good for us. It's good for you. It's good for everyone. So we're always happy to help and brainstorm with anyone brand new, super experienced, and everyone in between.
Awesome. 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 All right, guys. Well, you guys know the drill. This podcast is free. This information is free. But all we ask for as payment is that you guys just do us a simple thing. Like this video, drop a comment, leave us a review. Apple, Google, Spotify, send us a DM. James and I love reading them. That's why we do this. And if you guys like for us to continue to bring on guests just like this to provide top-notch information to help you reach financial independence and achieve your goals of financial freedom, make sure to follow this, share this with a friend who's going after the same thing, and we'll catch you next time. See you guys.
See you guys later.
Thanks, guys.